Hey everybody, this is Paul Dirks, Fund Manager with Dual City Investments, welcoming you to the Dual City Advantage Fund presentation. Quick note on our presentation here. We invite you to look at our disclaimers. Please understand that anything we discuss, including past results, does not guarantee future results, and any projections have been prepared based on numerous assumptions made by the Dual City Advantage team. So who are we? Who is Dual City? We're an owner and acquirer of commercial real estate assets since 2014, and our vision as a firm is to generate substantial upside for our investors through consistent returns. You'll see here with the map on the right-hand side, the markets that we're in terms of having current properties, and also the potential markets where we evaluate prospective properties for inclusion in the Dual City Advantage Fund. The bottom line picture here, and we'll get into more of these about the particular markets we're in, the strategies we follow, and also the asset classes we invest in, is that we know who we are, we have our niche, and we're really good at it. Now, who is Dual City? Here's the team. The team was founded in 2014. Our firm was founded in 2014 by Keith Nelson and Mike Migliaccio, who are friends, longtime friends, from their time together in law enforcement. You know, when you're doing your own investigative work, you're looking at different angles and assessing all kinds of risks as you do in law enforcement, that becomes a very strong foundation for work in real estate investing. Those concepts, those tactics, those ideas, that mentality is ingrained into our DNA, and it provides the foundation for the underwriting and the management we do on behalf of all of our investors. Looking at the rest of our team, you can see that we have deep experience in several different areas, including acquisitions, asset management, accounting, and financial markets. In total, we have over 50 years of collective investing experience and over 10 together as Dual City. Now, looking at the company's evolution here, I want to point out a couple different things. First of all, if you look at 2014 when the firm was started, we started as a syndicator, providing single asset syndications in several different asset classes and markets. While those performed very well, we elected to move to a fund model in 2017 to become a little bit more nimble. But that fund, which went for about 5 years, limited our ability to redeploy capital because it was a closed fund. We were able to generate a 22% IRR over those 5 years, which included the COVID lockdowns. But we elected to close that fund altogether and open the Dual City Advantage Fund in the spring of 2022. Despite the last 2 years presenting a mixed real estate market, we've delivered an average quarterly distribution to our investors of over 6% and a tax equivalent yield of about 10.5% when you assume a combined 41% federal plus state tax rate. In 10 years as a company, we've never missed a scheduled distribution. We've had a 100% positive track record for our investors, and we believe we've shown the ability to steward investor capital throughout market cycles. So I touched a little bit upon this about our rationale for getting into an evergreen fund, but I wanted to expand beyond that and point to 4 key reasons why we choose an evergreen fund for our model on how to deliver value to investors. First of all, we're nimble to invest where we see opportunities. Over the past 10 years, we've acquired, operated, and disposed of a wide range of assets in many markets. We feel that identifying opportunity is one of our biggest strengths, and the fund model gives us the most runway to do that on behalf of our investors. By following an evergreen fund model, we are able to do what's right for our investors. Unlike many others, we're not beholden to one kind of property, one kind of market, or one single strategy. We have a deep reservoir of experience over the last 10 years to draw from, and we can consider a multitude of different ways to enhance value and drive investor returns. We're also not motivated by doing a large number of transactions or charging high fees. Every fund manager at Dual City is personally invested in the Advantage Fund and is focused on protecting and growing the investor capital in the fund. A third reason for why we choose an evergreen fund is that it's diversified across asset classes and geographies. But beyond just those things, we are also diversified in terms of how we look at operations and the financing for each asset in our fund, and also the strategies for extracting maximum value upon disposition. We feel as if that's important to not have all of your eggs tied to one market assumption or one exit environment, which may or may not manifest itself years down the road. A fourth point is that we avoid selling assets at inopportune times. Our portfolio consists entirely of stabilized cash flowing assets, and we can continue to underwrite conservatively, carry a conservative amount of debt, and prioritize cash distributions to our investors. Having a fund model allows us to diversify the risk appropriately and make sure we can deliver upon our stated objectives to our investors. So this slide includes really the crux of the Dual City Advantage Fund. We're an evergreen private equity fund that's focused on protecting and growing investor capital. Like a REIT, investors in the Dual City Advantage Fund, or DCAF as we call it, receive 90% of net cash from operations in certain liquidity events. That's 90% of profit share. Also like a REIT, investors in our fund maintain liquidity via redemption rights. We'll talk a little bit more about that later. But unlike a REIT, investors in the Dual City Advantage Fund are limited partners with direct ownership of real estate assets, and thus they receive tax-free quarterly distributions, depreciation tax benefits via pass-throughs, and assets that are not correlated to stock market or subject to share price volatility. Since 1980, according to JP Morgan, REITs have a 0.6 correlation to the S&P 500, which I believe is something that's underappreciated by investors. Here, with DCAF, the Dual City Advantage Fund, you are directly investing in real estate. You're not investing indirectly through a REIT, which is, again, a publicly traded security. Investors in our fund also have a multiple number of ways to participate. They can invest through cash, trusts, non-retirement accounts, through self-directed IRAs and solo 401k retirement accounts, then also uniquely Section 721 property exchanges, which we'll discuss a little bit later. On the right-hand side of the slide, I would call your attention to 5 key benefits of the fund. Passive ownership for you as an investor, asset diversification, again, away from the stock market, tax-free cash flow, equity appreciation potential, and those liquidity redemption rights. Please note that DCAF, the Dual City Advantage Fund, is a 506c offering for accredited investors only. And please see our private placement memorandum, or PPM, for more information on the fund's risks and opportunities. Diving into the fund strategy. Here, I highlight 4 things that are important to consider on how we evaluate and work through the fund. We buy and operate with investor capital protection at the forefront of our investment thesis for each property and for the fund in totality. We execute value-add strategies to grow net operating income and enhance value. We activate that increased equity through sale, refinance, or exchange, and we redeploy that capital into other assets, which we find to be the best mechanism to accelerate growth and compound returns. On the point of buying and operating with protection of investor capital at the forefront, we're proud to say that we've never lost a penny of our investors' funds in over 10 years, but that protection of investor capital expands beyond just looking backwards, right, at past purchases, past acquisitions. You can also lose investor capital by how you allocate that capital in the future, meaning if you buy at unreasonable valuations today or make aggressive assumptions in your models, you can put your investors' capital at risk. Capital preservation is of utmost importance to us as a firm. And if you were to equate it to a baseball analogy, we're much more likely to hit singles and doubles than swing for the fences. On the redeployment side, as I said earlier, finding opportunities is one of our key strengths. So with an evergreen fund, we can do this not only when we initially acquire an asset, but also when we're thinking of disposing it in favor of the next acquisition. This allows us to help our investors reduce reinvestment risk and instead enjoy quarterly cash distributions and the tax advantages that come from passively investing in real estate. Here on our investment process and criteria slide, I briefly show for you the Dual City buy box and also the way in which we filter potential acquisitions through our due diligence filter and whether or not we consider making a bid, acquiring, and then admitting them into the fund. On the right-hand side, you can again see the primary markets that we operate in and also those secondary markets and tertiary markets that we look at. If you look at our buy box here, which is highlighted, I would say, and I want to highlight, that we operate in what we believe is a sweet spot in the real estate investing world. We're bigger than mom and pop investors, but we're smaller than large institutional players. What this does is it gives us the ability to work our large network of relationships from having served as a firm for over 10 years and having over 50 years of collective investment experience. but it also allows us to be creative and thoughtful when it comes to acquisitions. Given our size and given our discipline, we don't get into bidding wars. We're not afraid to say no, and we stay true to our knitting. That, we believe, is the best way to protect and grow our investors' capital. Here's the framework for investor returns from investing in the Dual City Advantage Fund. First, there's cash distributions, which have averaged over 6% since the fund's inception. Next, there are value-add strategies that over time are aimed at driving higher net income for each asset in the fund. We subscribe to the view that real estate is a get-rich-slow kind of investment, and steady execution on value-enhancing strategies is part of the recipe for driving investor returns. Then there are the tax advantages that come from investing in real estate, which augment your return, and from having sponsors like us who look to redeploy equity in a tax-efficient manner. All of these are factors that drive investor returns in the fund. Again, there at the bottom, you can see what we aim to deliver. I've highlighted protection of capital, but also a balance of short and long-term income and growth, and then passive real estate ownership for you as the investor. We do not take concentrated risk. We, by investing in real estate, are not correlated with stock market volatility or daily price movements. And as we'll show in a later slide, we are not interested in charging you, our investors, with excessive fees or taking a large share of profits. This slide, while a little bit busy, highlights a lot of the key elements of our fund's performance since we incepted in the spring of 2022. You'll see that we've delivered a great deal of value to our investors over the past 2+ years. A few of the highlights. Since our inception, we've paid our investors regular quarterly distributions, again, 6.2% on average. We've capitalized on the strong residential market, which include the sale of residential properties. We diversified our core tenant base. We kept our debt position low, and we've positioned the fund for opportunity here as markets begin to soften. The pie charts on the right show the fund's exposures by asset class, geography, and tenant. We believe we have a strong foundation in the fund that not only gives our investors resilience, but also flexibility for what's ahead. This is an important slide I'd like to spend a minute on, and I'll get a little technical. As an investor, you become a limited partner who receives distributions from the Dual City Advantage Fund. Distributions are classified as returns of capital. Returns of capital are not taxable until a partner's entire capital account balance is exhausted. That said, the fund has a track record of producing positive net income, which replenishes the capital account of the fund's partners. Because of this dynamic, we use tax equivalent yield to compare our distributions, which are non-taxable returns of capital, to other investment opportunities that are fully taxable at ordinary rates. Of course, every investor's tax rate varies by their income level and state of residency. So for this illustration, we chose a middle ground that assumes a 37% federal tax rate and a 4% state tax rate, which may be above or below yours. 37% plus 4% make 41% combined tax for the investor. In 2023, for an investor with that 41% combined federal and state tax bracket rate, the Dual City Advantage Fund produced a tax equivalent yield of 10.8%. Over the fund, for that investor, we've produced 10.5% average over time. Again, if you live in a high tax state, this tax equivalent yield is even higher. We believe this performance is strong and quite compelling, given the fact that we, again, keep a conservative level of debt in the fund, and that we, as an industry and as a firm, have experienced a wave of inflationary pressures over the last couple of years. Recent developments in the fund, there's 3 that I'd like to highlight, and these relate to how we've managed the fund and our outlook for what's ahead. First, we didn't see many worthwhile investment opportunities over the past couple of years. We think we'll be rewarded for our discipline and prefer to let other, less experienced operators take greater operating or financial risks. And while inflationary pressures are easing, inflation is still up and represents a hidden risk. Second, we disposed of non-core assets and made a number of improvements to our existing tenant and asset base. One of the moves we made was to execute a Section 1031 exchange of a portfolio of properties into a higher quality industrial property. This kind of exchange demonstrates how we aim to tax efficiently redeploy our investors' capital, reduce reinvestment risk, and keep compounding returns. Third, and what has us increasingly excited, is that with market conditions softening, we're we're seeing seller expectations resetting to more appropriate levels, and thus are beginning to see more attractive valuations in the marketplace. We expect this dynamic to translate into more buying opportunities for us and our investors in the second half of 2024 and into 2025. A quick slide here on fees. I mentioned how we aim to put our investors first. What better way to do that than to charge a single low fee and give investors a high profit share? That's exactly what we do. With our fund, we charge 1.5% of net asset value to manage the fee, which is below many other active managers out there, especially in the real estate and alternative investment space. And that's it. We haven't collected an acquisition or disposition fee. We don't charge for committing capital or placing debt, and we don't have any other ancillary fees. And from a profit share perspective, I mentioned this earlier, investors get 90% of profits. That's far above many single asset syndications out there, and it's in line with the split that investors receive if they were to invest in a publicly traded REIT. We can't be all things to all investors, and we recognize that. But for many investors, we provide a valuable solution. This slide summarizes many of the things that prospective investors we talk to consider when they're evaluating passive real estate investment. And as you see, we think we line up pretty well. One point in this list, and I encourage you to take a quick look through it and see how we may fit your potential criteria for investment, is I want to focus on liquidity. While real estate is a long-term investment, we understand that life circumstances change, and we want our investors to have an option to get liquidity if they need that. Oftentimes, you don't have that option if you're investing in a multi-year syndication or in other highly illiquid funds. Investors in the Dual City Advantage Fund receive redemption rights, which provide investors the right to withdraw their funds with 90 days notice, subject to the fund having sufficient cash on hand. This is a nice perk when compared to some of those other offerings out there that have no liquidity provisions for investors. Briefly on Section 721 exchanges, I mentioned at the outset that one of the unique features about our fund is that we can accept capital contributions in a few different ways. Obviously, there's the traditional ways of cash and trusts, and then also retirement accounts like self-directed IRAs and solo 401ks. The third option for us is to accept a Section 721 property exchange. In short, a Section 721 exchange is a tax deferral strategy that allows a property investor to contribute their physical property to a partnership like the Dual City Advantage Fund in exchange for interest in the partnership, and thereby deferring capital gains taxes until operating partnership units are sold. For real estate investors who want to transition from active management to becoming a passive investor and diversify from one asset to a diversified portfolio in one single transaction, a Section 721 exchange may be a possibility. In the purple box here on the left, you'll see that we've laid out just a few of the potential scenarios where a Section 721 exchange may make sense. Feel free to reach out to us if you have more questions on this strategy, but please be sure to discuss any potential tax strategies with your own tax advisor. So in summary, why invest in the Dual City Advantage Fund? There's multiple ways to invest. We just went through a few of those: cash, trusts, self-directed IRAs, solo 401ks, or Section 721 property exchanges. There's multiple ways to earn returns: cash distributions quarterly, equity appreciation potential over the long term. There's multiple investor advantages that accrue to you that may not be available to you in many of the other investments out there. Those, of course, include diversified real estate ownership, tax-free returns of capital, and liquidity redemption rights. Actively buying and operating a diverse portfolio of commercial real estate properties isn't for everyone, but you as a passive investor can leverage our experience, you can leverage our energy, and you can leverage our expertise to help you achieve your financial goals. Thank you for your interest in the Dual City Fund. Again, my name is Paul Dirks. If you have questions, please reach out to me, Mike, or Thomas on our team with any questions on the fund, on our company's history, or anything else that comes to mind. Prior to making an investment, please again be sure to review the fund's private placement memorandum and other fund documents. Thank you for your interest in Dual City, and we look forward to speaking with you soon.